I've listed here some of the things which we're going to discuss, including updates on the new overtime regulations, the 2020 limits, which I'm sure you have seen already, but we have combined them into a couple of compact slides so you can see everything at once. Federal and state unemployment taxes, wage bases, state minimum wage changes, some news on the new 2020 Form W-4 and its effect on employee withholding, as well as federal and state changes to earned income credit notifications. So looking quickly here, let's begin with the 2020 statutory limits, which I'm sure you're aware include the wage base for Social Security, which is now $137,700, with a maximum contribution for this year of $8,537.40 for both employers and employees. The Medicare rate, as before, has no wage limit, and the additional Medicare rate kicks in for employees only at taxable wages in excess of $200,000. That's 0.9%. For deferred compensation, the maximum deferral this year, if you have a 401k, 403b, or 457 account, the maximum is $19,500 unless you opt to go into catch-up contributions, and that is an additional $6,500. So that makes a total of $26,000 for anyone who is of catch-up contribution age, and that means anyone who will turn 50 this year and older. If your company, a small business, uses the IRA option, the simple IRA, the maximum contribution this year is $13,500 and a catch-up contribution there of $3,000. For Section 125, catch-up contributions, I'm sorry, I misspoke there, excuse me. Section 132, qualified transportation benefits, $270. And that goes for transit passes, qualified parking, or commuter highway vehicle maximums. The monthly maximum for each is $270. Under health care spending, and we're talking only about flexible spending accounts here for health care, the maximum this year, $2,750. Qualified adoption assistance, and we have an asterisk there. The maximum that can be reimbursed to an employee for adoption assistance is $14,300, but there is an income limitation that kicks in. And it begins to phase out when the employee's income reaches $214,520, and then the assistance phase-out ends when the income reaches $254,520, at which point there is no qualified adoption assistance. Any assistance will be taxable above that threshold. Mileage rates. For business, a decrease to 57.5 cents per mile from last year's 58 cents. The mileage rate for charity-based activities and for medical travel remain unchanged from last year, respectively 14 cents per mile and 17 cents per mile. For health savings accounts, the maximum contribution is $3,550 for an individual plan. This is to the account, not for the high deductible health plan. This is only for the health savings account. The maximum contribution for an HSA family plan, $7,100. And as you know, HSAs only work with high deductible health plans, and in this year, high deductible is construed to be $1,400 minimum deductible for an individual plan, and $2,800 is the minimum deductible for HSA family plan coverage. And again, there is a catch-up contribution available if an employee opts into that. And note here that the age for catch-up contributions for health savings accounts is not 50, it is 55. And an employee can add an additional $1,000 into their health savings account if they so choose and they are over the age of 55. Employers also can contribute to the health savings accounts. Right. The Tax Cuts and Jobs Act did make substantial changes, which you will see more of as we go through the slides here. But to begin with, let's review. Most of the changes in the Tax Cuts and Jobs Act took place on January 1st, 2018, and they will remain in effect through 2025. The first thing that happened, they retained 7 tax brackets, but it adjusts the rates in those brackets as well as the taxable income levels. The tax rates are also used to determine supplemental and backup withholding rates, and those rates have also changed. If you make supplemental wage payments and you identify them separately from regular salary, you should use the flat rate supplemental wage percentage. For federal tax, that optional flat rate is 22% for supplemental wages up to $1 million in a taxable year, 22%. Now, this will be familiar to you if you make payments of, say, stock updates, if you make commission payments that are large, if you make payments for executive compensation. If you exceed $1 million in a year, you will now use the mandatory flat rate of 37% for any amount over $1 million in supplemental wages in a taxable year. For this period, 2018 through 2025, while the Tax Cuts and Jobs Act rates are in effect. Now, the last paragraph there is something that you should pay attention to because we're going to touch on this again. The Tax Cuts and Jobs Act eliminated the personal exemption claimed by taxpayers for themselves. Now, for 2019, the standard deduction is $24,400 for married individuals filing jointly, and $18,350 for head of household filers, and $12,200 for all others. This will play in, again, in a few slides when we get to talk about the 2020 Form W-4. Here is an update on IRS reporting. If you are required to file Form 1095 for your employees, if you are an applicable large employer, you now have until March 2nd to provide those forms, 1095-C, to individuals. Now, the IRS has also extended transition relief from penalties if the forms are incorrect or incomplete. If you are an applicable large employer, you are familiar with those sections of the code and know that they deal with the mandatory reporting and the information that has to be included. The last sentence here is important. The penalties will be abated if the employer can demonstrate that they made good faith efforts to comply with the reporting requirements. And in this instance, the good faith effort refers to both furnishing the forms and filing. If you were able to get the forms into the hands of the employees in February, all to your good. If the forms were not filed with the IRS until April, you will have to work a little harder to have those penalties abated. I'm not saying that it will be impossible, but you may have to work a little harder. Right. We're going to take a look now. I'm not going to dive into it in as much depth as we can, but we are going to touch on the 2020 W-4. So let's take a look. You will see the final version is substantially changed from the 2018, which was the last real revision of the form. It is now called the Employee's Withholding Certificate. We have removed the word allowance because there are no more allowances. The questions on the form do not result in withholding allowances, but in amounts for withholding. And I can't stress this next piece enough. The IRS urges all taxpayers to use a tax calculator of some type. The withholding estimator helps you identify your tax withholding to make sure you have the right amount of tax withheld from your paycheck at work. You can pass this on to the employees that you're responsible for paying or any employees in your office. The estimator does work. Just make sure that you understand how to use it when you use it. So a few questions. Does your year-end plan and your plan for this year include a communication about the new Form W-4? You should consider it because of the changes. Employees should consult their tax advisors as well as using the tax estimator for assistance in managing their own withholding. Understand that the withholding is going to look completely different from the way it has looked in the past. Employees may be confused. So, the IRS has also created a new publication, which is 15T as in Tom. It's called Federal Income Tax Withholding Methods, and it will explain how withholding is calculated with prior year and 2020 forms. The wage bracket tables, the percentage method tables that always used to be in Publication 15 are not in Publication 15 now. They are here in this Publication 15T. Okay? So do not look for it in Publication 15. It will look different. This is page 1. This may be all a lot of employees need in order to work their withholding. Step 1, as you can see, is personal information. It includes the employee's name, address, social security number, and filing status. Very important. Single or married filing separately, married filing jointly or qualifying widower or widow, and third is head of household. And you can check that only if you are responsible for a non-dependent or a dependent non-child. Might be an adult for whom you are responsible. Here is again another place where this form is different. You'll note that the next sentence says complete steps 2 through 4 only if they apply to you. Otherwise, skip to step 5. Step 5 is simply the attestation and date, signature, date. If you have multiple jobs, or you are married and filing jointly, or your spouse works and you want to include both incomes in one W-4 for one job, That might be the case if, say, for instance, one spouse works part-time and the other works full-time. You may want to put the heavier withholding on the full-time spouse. That is your option, and that is what's covered in Step 2. Step 3 is where you will claim your dependents, and you'll note here that this is also different. It's a fairly simple question. If your income will be $200,000 or less, $400,000 if you're married filing jointly, you multiply the number of qualifying children under age 17 by $2,000, and then multiply the number of other dependents by $500. Let's take a look at what that might mean. To qualify for the child tax credit, which is the first part there, the child must be under age 17 as of December 31st of the taxable year, must be your dependent who generally lives with you for more than half the year, and must have the required Social Security number. You may be able to claim a credit for other dependents for whom a child tax credit can't be claimed, such as an older child still living with you or a qualifying relative. There is a reference. You need to look at Publication 972, Child Tax Credit and Credit for Other Dependents. So that will be Step 3 on the form. Step 4 is also optional. Those are other adjustments. First is other income. If, for instance, you have an additional job, or rather, excuse me, this is not from jobs. If you expect to receive interest that you will get a 1099 for, or if you receive dividends from the stock market, or if there is retirement income, you may include that in the total amount of income, so it will help you gauge additional withholding. Step 4B there is for deductions. If you are accustomed to itemizing deductions and you wish to continue to do that, you may estimate the amount of your itemized deductions. Step 4C is for additional withholding. Additional withholding, if you wish to add a flat amount to the withholding that will be calculated from this form. As we go through the pages, you'll see a little bit more about how that goes. These are the general instructions for filling out the form. You can read those to familiarize yourself with it. Okay, Step 3 here, page 3, is for the two things that we referred to before. The first is the multiple jobs worksheet, if you opt to fill that out, or if your employees opt to fill that out. It will walk you through calculations, and it will refer you to what is on page 4, which are the tax tables. And you'll see that at the bottom of the multiple jobs worksheet, you'll see Step 4 says divide the annual amount on line 1 or line 2C, referring from the tables, by the number of pay periods on line 3. So what it's doing is helping you come up with your annualized withholding and then dividing it by the number of periods in your pay cycle, whether you're weekly, biweekly, semi-monthly, monthly, whatever it is, so that you can come up with a per period withholding. And then Step 4B is the deductions worksheet. If you choose to estimate your itemized deductions, you can do that also. All of this is giving you kind of a snapshot look at what your withholding and what your itemized deductions might be for a year, and allowing you to forecast it and then estimate what your withholding may be for the year. And here is page 4, and these are the tables that you would use to come up with your annual tax. Let's take a look at the 3 tables. As we mentioned before, under filing status, the same filing statuses govern the tables. The first one is for employees filing jointly or a qualifying widower. And you can see on the left side going down the wage brackets for the higher paying job, annual taxable wage and salary. If you choose to use more than one job, you would then go across to find the annual salary for the lower paying job. So for example, if you had the higher paying job was $110,000. You would look at the line that says higher paying job and scroll down to $100,000 to $149,999. And then look across to that second lower paying job, which we'll say might be $40,000. $40,000 to $49,999, that amount is $8,220. And that would be the annualized tax for the higher paying job if you opted to do that, if you are married filing jointly. Looking down, the second table is for single or married people filing separately. So again, you would do the same thing. If you chose to do, if you are the higher paying, the higher salaried employee in the couple, you might use the higher paying job scale again. Instead of looking at the lower paying job, you would ignore it and go with the higher paying one and scroll across. If you were single, obviously, you would only be looking at one. You'd be looking at the higher paying job. And if you are the head of household, you might look at the lower paying job if you have opted to do so according to what's on the form. If you do not opt to do so, then again, you would scroll down the left-hand side and look at the higher paying job for yourself, and then figure out what your tax might be on an annual basis, your withholding, and then take that to the step which would tell you how to divide that into the number of periods. It is simpler and in a way more complex than the previous W-4 forms. So let's take a few more minutes to look at that some more. Something you should know, employees with a valid Form W-4 on file from a prior year are not required to fill out a Form W-4 for 2020 unless they want to make changes. Okay, again, as we said before, no allowances are used, but dependents can be entered. Non-child dependents can also be deducted at $500 per exemption. No allowances. You may add income from other sources to your estimate, or if you itemize deductions, you may reduce your withholding by completing the deductions worksheet. You can also request additional withholding per pay period, and it's now called extra withholding. And may be of interest to you, an employee can still claim exempt simply by writing the word exempt below item 4C. Now, we can go back and take a look at 4C and see where it is. Okay, 4C, extra withholding, enter any additional amount you want withheld each pay period. You see there's a line there. Underneath 4C, you can print the word exempt so it can be seen. We'll talk about that in a little while because there are some items that we need to reckon with even though the W-4 form has changed completely, there are still some things that we need to look at. Okay, just some reminders here to ensure that employees are filling out the forms correctly and you're accepting them on behalf of the payroll team. The employee can't enter a flat dollar amount for withholding amounts, but can only do that calculation and come out with the correct annualized amount and divide it by the number of periods. That's the only valid dollar amount that will be accepted. If an employee wants to have an additional amount because they've estimated and they're still coming out low, they can enter an additional amount per paid period to be withheld. And as before, crossing out any of the printed information or statements invalidates the form. It can't be accepted. The form must be dated when it's submitted. No future dates are permitted, and of course it must also be signed. And if the employee indicates verbally that the statements on the completed form are false in any way, the form is invalid. And just a reminder, we say this all the time in the payroll world, payroll team members are not tax advisors, nor are they the W-4 police. What does that mean? That means if they receive a form that appears to be valid on its face, it's filled out correctly, it's dated with the current date, nothing else about it appears to be invalid, it has to be accepted. However, on the other hand, if someone brings a form to you and pretty much tells you verbally right into your face that the form is false, then you cannot accept it. You have to ask that person very politely to please redo the form and to make sure that it's valid. Those of you who are familiar with working in payroll understand that there are times when you will need to practice your diplomacy and ensure that you are getting the form that you should receive from the employee. And just again, another reminder about the tax withholding estimator. We'd urge you to use that if needed and have employees use that. We will make a number of these links available to you also so that you'll have them in one place. There are a few other links you'll need to see as we go forward. So here's a question. How are the state forms affected? You'll know that if you work in certain states that certain states, first of all, some use the federal W-4 to calculate state withholding. Now, since the W-4 for federal purposes has changed radically and there are no more allowances, states need to develop and distribute their own new methods of calculation. Some states have still decided to use the federal form W-4. Those are Colorado, New Mexico, North Dakota, and Utah. And we have Pennsylvania. Pennsylvania doesn't use a certificate because it uses a gross income tax and it's a flat percentage. There are no allowances or exemptions permitted. So there are also a large number of states, including the ones listed here, California, Delaware, Minnesota, New York, who formerly permitted the federal form W-4 to be used for state withholding purposes. In other words, if you filled out your form W-4, your federal form W-4 as single with one allowance, that could be defaulted to those states. There were probably about 25 or so states that permitted that. Now, most of these states now have mandated the use of their own form, can no longer use the federal form W-4. And just as a reminder, there are still 9 states that don't impose an income tax, so you don't need to concern yourself about those, or they don't impose it, let's call it a tax on wages. So be sure to verify the status of your state's withholding forms before deploying the form to employees. Just verify. Most of the state tax departments have up-to-date forms, or they have at least a place where you can ask about it, where you can go to them and verify what they're using so that you will not be out of compliance for your employees. Adrian, is it possible that we can do this poll? Yes, thank you. Would appreciate it if you'd like to answer. I'm curious as to whether you will be revising after the revision to the W-4. Will you be sending out a reminder to your employees to urge them? Just a few seconds left. Please answer if you can. Do we have responses? Great. I'm very happy to see that 60% of you plan to discuss this or sending a reminder to your employees. It's a good idea just to open the conversation, and if people have concerns, there are things that you can tell them. At the very least, you can give them the form and give them the tools to allow them to work on it themselves by simply providing the information about those calculators and publication 15T, and urging them to talk to they're probably going to have their tax returns done, and if so, they can ask someone for assistance. That's great. Very glad to hear that. All right, moving on. Effective January 1st, new overtime rules. The rules were published in September, ending a long limbo period in which various versions of the rules were discussed and put up and knocked down. Non-exempt employees who are paid salaries of less than $35,568 must be paid overtime. For those non-exempt employees earning more than that threshold, employers can make determinations based on the job duties, but those employees might still be eligible for overtime. Let's look at one thing that may affect a number of employers. The rule allows employers to use non-discretionary bonuses and incentive payments, including commissions, paid at least annually to satisfy up to 10% of the standard salary level in recognition of the changing pay practices. So, if you have employees who are under the $684 a week and they are non-exempt and they have not received the amount of money that they should have, the IRS will allow employers, or I should say the Department of Labor, will allow employers to use non-discretionary bonuses, even if you make it a one-time bonus, that can pay up to 10% of that standard salary level, or in other words, $3,557, a maximum for, I would say that it should be just for this first year. After that, Practices should be updated to ensure that non-exempt employees are all receiving a minimum of that $35,000. If at the end of that 52-week period, the salary paid plus the additional payments do not equal the standard salary level, in other words, the $35,568, the employer would have one pay period to make up the shortfall. One period. So that means that there have to be some very good tracking mechanisms in place if you have a significant number of non-exempt employees who are earning below the threshold of $684 per week. Now, at this point, there is no provision for changing the salary level after a specific time period. It's possible that at some point there will be, but as of right now, there is not. They may have to go through this again in a couple of years in order to keep up with actual salaries in the real world. And the final rule only changes salary. It does not make changes to the job duties test, which is one of the ways that exemption from overtime is determined. And it doesn't include a provision to automatically adjust the salary threshold. So this may stay this way for a few years until the Department of Labor is able to make the next set of thresholds and job duties in whichever way they choose to upgrade what happens to employees who are non-exempt. This was a long time coming. So you would hope that it would not take another 30 years for it to happen, but you never can tell. So this is the current standard, and it went into effect on January 1st. So everyone should be earning at a minimum of $684 per week to be exempt. However, employees can still be non-exempt and earn more than $35,000 per year. So that is something that, of course, is a function of the company's salary structure, and they will need to address that individually. This is simply the FLSA overtime guideline, giving employers time to make changes. The federal unemployment tax rate for employers is the same. It is still 6%, and employers who make all payments timely to their state unemployment funds will receive that credit of 5.4%, making employers' effective rate for FUTA 0.6%, and the annual wage base is still $7,000 per employee. So the 50 states, Puerto Rico, and the U.S. Virgin Islands that were in credit reduction status received less than the full 5.4% credit, and therefore they paid more in their FUTA payments for 2019. Now, as you know, the Federal Unemployment Tax Act, along with state unemployment systems, provides for payments of unemployment compensation to workers who have lost their jobs. Most employers pay both a federal and a state unemployment tax. Only the employer pays FUTA. It is not deducted from the employee's wages. When we get to looking at some of the state rules coming up, you'll see that there are a few states that do charge employees a small percentage of unemployment insurance deducted from their wages. So the federal unemployment fund supplements the state funds, and it provides loans, this is very important, to states that have too low balances in their unemployment funds. So some states are required to take those trust fund loans from the federal government if they lack the funds to pay unemployment insurance benefits for residents of their states. A state is a credit reduction state if it has taken loans from the federal government to meet its state unemployment benefits liabilities and has not repaid the loans within the allowable time frame. A reduction in the usual credit against the full FUTA tax rate means that employers paying wages subject to UI will owe a greater amount of tax. As we said here, the full credit is 5.4%. However, based on the formula that the Federal Unemployment Trust uses, if if states have not repaid the full amounts of the loans that they've taken, after 2 to 3 years, they begin to be penalized, meaning that this credit is decreasing every year. So if a state has outstanding loan balances on January 1st for 2 consecutive years and does not repay the full amount of its loans by November 10th of the second year, the FUTA credit rate for employers in that state, every employer in that state, the credit will be reduced until the loan is repaid. So we have only one credit reduction state for the full year of 2019, and that is the U.S. Virgin Islands, and they have been in deficit for more than 1 year. So they now have a credit reduction of 2.7%. as opposed to the total, the maximum, which could have been 5.4%. So they've passed a few consecutive January ones with an outstanding federal advance, and the employers there, any employer in the Virgin Islands, is now required to bear that credit reduction. Let's take a look at our state unemployment update here. The states that have changed their unemployment wage basis are listed here, and we've listed their 2020 wage basis. As you can see, there's not just one, there are quite a few. And if the wage base is going up, that means generally that employment could be better in these states. And as you can see, in some cases, there's a balance. Some states prefer to raise the wage base, which means that every employee in that state the employer is paying more on that employee's behalf. Take a look at Hawaii and Idaho. You see the wage bases are over $40,000. Also Alaska, as well as Oregon. Washington State is actually $52,700. That means that each employee is responsible for more of the unemployment burden. That means the employer is paying more per employee per year. This tells me that there is less employment than the state would like to have. In states where there are more employees per capita, shall we say, then there can be a lower rate. So taking a look at, let's see, Kentucky, $10,800. Arkansas went back down to $7,000. New York is $11,600. Ohio, $9,000. Puerto Rico, $7,000, and so on. In places where you expect more of a larger percentage of the population to be employed, the wage base can go down. The rates may go up, but the wage base may go down. So there are some stickouts here that we'll take a look at. For example, Rhode Island. You look over here, Rhode Island, wage base for the year is $24,000, but if you are in the highest UI tax rate as an employer, you're paying more. because the wage base is higher for those in the highest tax rate group. So that will be on an employer-to-an-employer basis. On the other side, Michigan employers who made all their payments timely are not paying $9,500, but they are paying based on a wage base of $9,000. In Nebraska, Nebraska's rate is, I believe, $9,000 or $10,000, but it is higher for employers assigned to rate category 20. And in Tennessee, Tennessee may increase their fund. As of January, the trust fund balance was just on the borderline where they might have increased their wage base by $500. I left it out because we didn't have final information as of that time. So as you can see, we have a number of states. These states have changed their wage bases for this year. This is a number of changes that I found when I went through this as late as yesterday. So this is as up to date as we can make it. This is all part of budgeting. When the financial teams are budgeting for your employer, you have to know what that wage base is going to be so that you can estimate how much you'll be paying in unemployment. So looking here, we now have only 3 states that require a payment from the employee for unemployment insurance. It's a small portion. The employers also pay, but in Alaska and in New Jersey, they have these amounts are their current wage bases, and the rates here, 0.5% and 0.425%, are the current wage bases for the employer also. Now, Pennsylvania, of course, it's based on all gross wages, and the employees pay 0.06%. The next grid is all about disability insurance, state disability insurance, and paid family leave, and these are the employees' premium amounts. So as you can see, this number is increasing every year because more and more states are adding paid family leave to their roster of benefits. As you can see, they do differ. Let's say, for instance, Massachusetts has gone into effect this year, and they actually are using the Social Security wage base, and 0.75% of the employee's pay goes for the paid family leave. These are employee percentages. Very often the employer is paying a segment of this also. So let's take a look at Washington State. They also are using the Social Security wage base. And I have asterisks there because this number may float. They have determined that the employees will pay just under 2/3 of the premium and the employer will pay the balance, which is around 36%. So right now they have pegged that at 0.4%. It may change. So we have disability here too. These are temporary disability premiums that employees pay. In California, this disability insurance premium, the wage base has been about that amount for, it goes up by the year, shall we say, but it is not quite as high as the Social Security wage base, but it's heading in that direction. Hawaii has a weekly amount. That is the maximum wage base that the employee would have to pay, and 0.5% of that goes to their disability insurance fund. New Jersey's New Jersey is interesting in that you'll see above their unemployment insurance wage base is much lower, but the disability and the family leave is much higher, which means that they are attempting to raise the amounts of money in the funds that pay for the disability, temporary disability, as well as they refer to this as FLI, or Family Leave Insurance, which was the name it was given a few years ago before many states started to use the acronym PFL for Paid Family Leave. New York has a maximum of 60 cents per week that an employee can pay into, and their disability is really based on an actual policy that an employer has to use in order to cover their employees for temporary disability. The maximum that an employee can be charged is 60 cents per week, or maximum of $31 per year, basically. The employer has to cover the rest. Now, New York's paid family leave has the annual deduction for employees, as you see in the note there. The maximum annual deduction is $196.72, and it's 0.27% of this $72,860. So every one of the states here has either a disability or a paid family leave coverage, and the employees are paying into those. The employers are paying the balance. Next, we want to look at minimum wage updates, because even though there is a federal minimum wage set, I'm sure that you are all aware that the federal minimum wage is exceeded in many, many states and localities. And it may be covered, and it may be based on inflation as measured by the Consumer Price Index, or it may simply be a function of the cost of living in a specific locality or state. So we're going to take a look now at the updated list of minimum wage increases for 2020. And I will say that these are the rates that we're changing for January 2020. If the change is scheduled for later in the year, it will not be included here. So these are the latest minimum wages as of January 1st for the states who changed. I am also giving you the tipped wage in case the state uses a tip credit for employees in industries that rely heavily on tips. So for Alaska, as you'll see, they've gone up to $10.19. They do not use a tip credit. California also does not use a tip credit. California has 2 levels of minimum wage based on the size of the employer. Minnesota does the same. And you'll notice that if there's a small employer, they do not use the tip credit. They simply have 1 hourly rate. So you'll see that some of the states use this tip credit and some do not. And that is the state's prerogative. So going forward, we also have some more here. New Jersey is another state that has multiple rates based on the size of the employment, and also New Jersey uses the lower rate for seasonal employers. They have a number of seasonal businesses that run in the spring and the summer, say, as we say, down the Jersey Shore, and places where there is a lot of seasonal employment, vacation areas and so on, there's a slightly lower minimum wage. And there also is a tipped wage, and you'll see that the tipped wage in both cases is exactly the same, regardless of the size of the employer. New York complicates things just a little bit because they tend to make the tipped wage and the tip credit a function of the number of employees and the size of the revenue of the company that is actually using the tip credit. So I put there will vary because that is something you would have to verify based on the employer. So, and New York also uses multiple rates. The $11.80 is the overall New York State minimum wage. It does not apply in New York City, and it does not apply in the close-in suburbs. There are only 3, I believe, that are included in that, and those close-in suburbs have a separate rate. Ohio also varies on the size of the employer, and so on. So you can see that the minimum wage is updating everywhere, and it is an attempt to keep people working and to allow them a way to actually live. So let's take a look at what that tip credit means. Using a minimum wage of $11 and a tip credit of $5.50, the employee must earn $440 for a 40-hour week. So if the tip credit of $5.50 is deducted and the employee earns $5.50 per hour for 40 hours, that comes to $220. And then that employee earns $150 in tips. That total is $370, and it's short of the required $440. Therefore, the employer must supplement the wages with an additional $70 to reach the minimum required for 40 hours of work. Again, using a tip credit depends entirely on the nature of the tip business. If you are in a business where tips are lavish and they are consistent, then you may want to do that for cash flow purposes. Paying someone $5.50 an hour instead of $11 saves on cash flow, but you also need to verify that that employee is going to be made whole at the end of the week. If they're consistently falling short, then you need to look at practices somewhat. So that's an illustration of the tip credit. So this is something else to be aware of. Municipalities and cities may choose to have higher minimum wage rates. Check your local rules. These are the cities and metro areas that were available on the day when we reviewed this material, which was last week. So as of last week, these were current. We have the city of Flagstaff in Arizona. We have a number of cities in California, and if you look at them closely, which we don't need to do right now, you will note that they are all surrounding Los Angeles, San Diego, and San Francisco, which means that close-in suburbs tend to raise their minimum wage rates in order to, number one, assist people in cost of living, and number two, to stay competitive. So in Denver, Colorado, in the city of Chicago, and also in the overall Cook County, which includes Chicago, there are 2 different minimum wages which are both higher than the overall state of Illinois minimum wage. Montgomery County and Prince George's County in Maryland. The Twin Cities in Minnesota, the largest and most government and tourist-focused parts of New Mexico, Albuquerque, Bernalillo counties, Las Cruces, Santa Fe, and the county in which Santa Fe sits. And again, in New York City, and the 3 close-in suburbs I mentioned, Nassau, Suffolk, and Westchester County. They are governed by separate minimum wages. The city of Portland in Oregon, the cities of Seattle and Tacoma in Washington. So if you have employees in those cities, you should be verifying that they are all earning the correct minimum wage. Now, when we talked about the Tax Cuts and Jobs earlier, we mentioned that the Act made some changes to the federal supplemental withholding rates, and some states, in response to that, also made changes to their supplemental withholding rates. Please note, if you're paying bonuses, incentives, commissions, or other supplemental wages separately from regular salary, you may need to use these supplemental rates. Check your state's tax department for the most up-to-date information. Federal rules require that employees who have no federal tax withheld from their wages be notified that they may be eligible for a refund because of the Earned Income Tax Credit. Now, these are federal rules. Employers are also encouraged, not required, but encouraged to notify employees whose wages for 2019 were less than $50,162 that they may be eligible to claim the credit. Let's take a look at the Earned Income Tax Credit for a minute. So you're required to notify employees that have no federal tax withheld. Now, you don't have to notify employees who are exempt or who claim exemption from withholding on Form W-4 about the Earned Income Credit. You are encouraged, as we mentioned, to notify employees whose wages were lower than the threshold of $50,162. This is because eligible employees may get a refund of the amount of the Earned Income Credit that is more than the tax they owe. So how do we meet this requirement? For federal reporting purposes, most of you will have noticed that there is an Earned Income Credit notice on the reverse side of Copy B, which is the employee's copy of the W-2 form. And that is considered sufficient notification in most states, not all. The IRS also provides Notice 797, and you can also provide a statement that contains the same wording as 797. However, there are a few states that require different notifications because they may have their own Earned Income Credit with different requirements than the federal government's requirement. So let's take a look at those. California requires that all employees be notified and requires a separate statement. The federal statement is not acceptable as a substitute. You may find yourself sending out separate letters or some sort of notification to everyone in California via postal mail, every one of your employees in California. Illinois requires a separate notification, and sample wording is available from the state. And it includes income threshold amounts, so that means it must be updated annually because the income amounts change every year. Louisiana requires that employees be notified of the Earned Income Credit upon hire if they earn less than $35,000 annually. And they must also display a poster. If you are an employer in Louisiana, you're all familiar, I'm sure, with the requirements that the federal government has for labor posters for certain items that have to be posted. They tell you about certain protections. They tell you about the minimum wage. They tell you about various types of protections that are in place for the employee. They tell you about workers' comp. They tell you about safety. Those posters are required to be placed in a location where employees all can have access to see them. They can't just be in one section of a multi-building campus if 3/4 of the employees never get to that building. They have to be in places where employees can see them. So the earned income credit posters will need to be in the same place in many cases. So Maryland says that the notice must be provided by December 31st. That is different. Many of the states say it's okay if the notifications go out by the time you send out the W-2s, which is January 31st. Maryland says no, they have to be out by the end of the year to allow people to give them time, to allow them time to be able to prepare for this when they go to file their tax returns and ask their tax filer how to apply for the earned income credit. So New Jersey says that notice has to be provided between January 1st and February 15th, along with the W-2 forms, to employees who may be eligible. Okay, now there's something different. New Jersey doesn't say that every employee has to have it. New Jersey only says that employees who may be eligible for either federal or state earned income credit have to be notified. That may bring up a question or two. For example, is it easier for us to just send out a notification to everybody, regardless of who's eligible? That's something that an employer would have to decide. So Oregon requires a separate notification about federal and state earned income tax credit eligibility. The sample wording is available again from the state, and poster notification is also required, and it must be included on the state minimum wage poster, which kind of makes sense. Now, Texas requires notification of the federal earned income tax credit by March 1st each year. And the IRS notice 797 that we mentioned earlier, it is acceptable, or another statement with the same wording. Perhaps you may want to send a memo out to every employee, and that memo would contain that wording, and if you sent it by mail, that is probably acceptable to satisfy the Texas law. It's difficult to create electronic communications and ensure that everyone sees them. So postal mail may be the way to go. Virginia requires a poster earned income tax credit notification to be posted where other labor notices are posted. Remember, we said they have to be someplace where majority, if not 100% of the employees can see them. And there is one locality, the city of Philadelphia, requires an earned income tax credit notice for the federal and for Pennsylvania state, and it has to be provided to employees by February 1st each year. So you are probably safe in that case sending it out with the W-2s. All right, we are ready for questions.